remember. Okay, chapter 7, moving to analyzing common stocks. So the next 3 chapters will be looking at analyzing and interpreting stock valuations, intrinsic value, using traditional and technical methods, behavioral methods, to get an idea of how people analyze stocks, decide what stocks to purchase, and how to make a huge amount of money. Okay, so we're going to discuss a securities analysis process, goals and functions of that, understanding the purpose of economic analysis. I'm going to describe to you and go over industry analysis, the basic appreciation of fundamental analysis, why we use it. I'm going to calculate and describe and talk about financial ratios, specifically how you can use financial ratios in buying and researching and investing in stocks. Now, you should be familiar from financial ratios from such great classes as financial accounting and finance. So don't act like you've never heard this before. And various financial measures of assets of companies' performance and how that we could use that for evaluation process. So we want to look at ideas and ratios and whatever data we can get to help us put a valuation on a stock. And then just talk about strategies for gathering information, organizing it into some logical framework or database, and using it to determine what you would call the intrinsic value of the stocks you're looking at. So first, this concept of intrinsic value is very important to understand. It's a number that you put on a stock that is supposed to reflect the underlying value or basis of the fundamental value of a stock. So you look at a stock and you have all these points of data, and you need to interpret that somehow, either through mathematical formulas, your own experience, relationships of how other stocks perform with similar metrics, and to come up with, a value that you could place on a stock. So, one thing I do sometimes is I don't look at the stock price. I just get the facts about the stock. I look at the financial ratios, the technical analysis, and I look at it, and then I try to put a price on the stock first, and then I check what the stock price is. So I look at the assets, the debt, the growth in earnings, growth in profits, everything that, any factor that I could look at that wouldn't immediately tell me what the price of the stock is currently. So I kind of look at what the company is, what they do, how I feel their products, more of a management side, business side, how I feel like the company would be positioned and the likelihood that they'll sell more or do well. And then I put all that information together and I try to develop a guess of what the stock price should be, or what I feel the stock price should be valued at. And then if I check the stock market and I'm putting a value of, say, $50 and it's trading at $35, well, now I'm incentivized to buy it. Usually, though, I put a value on it, and I'll say, like Yelp, I'll put a value on it of 35. I'll look in the stock, it's trading at 100. Well, right now, it's like 62. And I'll say, well, okay, this is too pricey. So you only really want to buy the stock if the market price doesn't exceed what you deem is the value of the stock. And there are stocks out there that many stocks I feel are undervalued and could be a good purchase. And there are a lot of stocks that are overvalued, but sometimes I buy them too. Because if a stock has momentum, it may be overvalued, but if it has a momentum trend where people just keep piling on, it just keeps moving higher, sometimes you just want to jump on for the ride. Knowing full well that, okay, this stock is overvalued, it's trading at a price way too high than it should, but everybody seems to love the stock, and it's moving higher and higher. I'm going to get in on it because this is a sector that is forming a bubble. So you may want to just ride a few momentum stocks on the bubble because you can make fairly fast returns. You can buy value stocks that are undervalued, and they'll sit there being undervalued for many years, and it's just very frustrating. So sometimes if you want a little bit more movement or activity in your portfolios, you want to jump on whatever has a momentum with it. If it's a downward market and there's a downward momentum, you want to sell short and play the downward momentum. What a lot of traders, especially people of your generation, you don't like stocks that just stay still and do nothing. It's very boring to you. So you want to have volatility. And this, this month there's been a lot of volatility. And that has been great for people trying to make money. It's also caused a number of people to lose money, but, the volatility, you have up or down 200 plus points, multiple times in a 2-week period. There's a lot of volatility and a lot of stocks moving good numbers that if you're a day trader and you could guess the right direction, which a lot of our people in the top 5 spots have been doing just that. They've been, sort of day trading positions, and the volatility has propelled some people in the virtual stock market to the top and other people to the very bottom. It's ugly down there. I didn't even want to go down there today because I felt that some people would get really upset if I said, look at this loser. How did you lose all this money? And obviously nobody's a loser in my class. If you lost a lot of money and you're in the bottom 5 positions, it means you're learning something as well. And you're learning, it's good that you're learning with fake money what not to do rather than real money. Sometimes it's worse if you're in the top 5 positions and you get this false sense of confidence that trading stocks is easy and you can make money, and then you decide to do it with your real money. But let me tell you, things change quickly when it's your real money because you hesitate more. You're not, it's almost better for some people to trade with money that they don't have to worry about. When you trade with your own money, you get very protective and a little hesitant, and you don't make the bold moves that you do make in the virtual stock exchange that propels you to the top. It's a whole different ball game. So intrinsic value, at least for me, depends greatly on the estimates of future cash flows. That would be the biggest thing for when I'm looking at a stock. The discount rate and the amount of risk, yeah, that's in there too, and I'm worried about that. The discount rate, not so much, but more so the amount of risk. The discount rate I'd worried about for more bonds and such, but for stocks, risk is an issue, but mostly I want to look at the estimates of future cash flow. So if there's a company, that's why this company, Lake, has been moving up, is because they're showing that their stuff is selling and their cash flow is increasing. And that's solid reasons for why stock's moving higher. Other companies, if they have a long-term, if you find a company that has a long-term strategy for increasing cash flows in the future, they have a product that's selling, like Apple's a great example because they have products that at a certain point expire. You wouldn't be caught dead carrying the original iPad around anymore. You have to have the iPad Air or it's just, you won't look cool. You can't have iPhone 2. Who has iPhone 2? Is there even such a thing? I've totally forgotten. You have to have iPhone 4 or above, preferably 6 Plus. If you really, because the bigger the iPhone, the more you can show people, hey, I got an iPhone. I'm somebody. But so these things, there are some people, you may know them, they'll buy, every new iPhone comes out, they'll get it, every generation. Some people may skip a generation because they wait for the 2-year contract to be up and get it through their phone company, but by and large, everybody wants the new. And that's great for Apple's cash flow. So they have a good cycle and turnaround on their phones and iPads because they're constantly updating them, making them thinner, more attractive features, different things that make them, people don't even need to update. If they could do that a little bit faster on their laptop side, I mean, these MacBooks, once you get one, they're good for at least, 5 years? And you could hardly tell that it's 5 years old because they don't really change that much in styling or look. But if they were able to create innovation a little bit faster on their laptop side, maybe they'd have even better cash flows. But what gets scary about Apple is even though they have these great increase in cash flows, how big can they really get? It seems like they're fully sized already. And I don't see anybody wearing an iWatch. I don't know if that's going to... Oh, they don't call it iWatch. It's just the Apple Watch. We want to get away from the I. All right. Okay. Now, in securities analysis, we do what's called a top-down approach that helps us filter and kind of get ideas of what stocks to trade. So the first step is the economic analysis, the overall state of the economy. And I think... No. Just checking ahead to see where I'm at. Okay. So we want to get an idea of how is the economy doing? right now, to me, the economy looks to be doing fine. At least the United States. Europe had some issues last week, and they've had issues for a couple of years. But when oil prices are declining, that's usually a pickup for economic activity. Because for people who buy gas or home heating oil, you're going to feel an immediate $100 to $200 increase in cash that you have every month. That's going to go most likely be spent. And especially for gasoline prices, if gasoline prices go down $1 and you're getting about, 30, 40 gallons a month, that's a savings that are going to go back into the economy. But it filters out to so many other things like airline industry usually does well as jet fuel prices go down, and anybody who's in transportation, all these trucks using all this petro, lowers inflation and makes the Fed a little bit more comfortable without having to raise interest rates, and usually sparks up the economy. So the economy looks decent. So that would tell me, should I be buying stocks or selling them short? So right now, if the economy is still looking stable or has nice prospects for increasing, that would tell me, okay, maybe I should be looking at buying stocks at this point. Because the economy. But if oil prices are going up in the economic analysis or going down, in this case they were going down, there's certain stocks I might want to stay away from. I probably would like to buy airlines because they'll make more profits when oil prices go down, because that's what jet fuel is made out of. But I probably want to sell solar companies like I did in the virtual stock market, because even though investors tend to overreact, they see oil prices go down, they dump all over the solar stocks, more so than they should, and force them down much lower than they really should be forced down, based on the impact. The oil prices being lower may slow the growth of solar companies, and they should go down $1 or $2, but investors will make them go down $10 because they overpunish them. I may be wary of oil companies that pump oil out of the ground and sell it, because now if oil prices go down, they're going to have less profits. But companies that use a lot of oil for transportation or manufacturing, I may look to purchase. So these are different economic trends. Next year, they think that interest rates will finally start going up as far as the Fed to increase their federal fund rates and move those higher. And that you got to look at, bonds will probably not do as well in that area. And certain financial companies could have a problem too. So you have to kind of measure all these potential predictors of the economy. And that leads to step two, the industry analysis, which I was sort of talking about already. What industries will prosper for the current economic shifts, and what industries will suffer? Now, if we're looking at the industry, we want to look. So we say that solar companies may suffer if oil prices go down. Well, let's look into the level of competition and the number of companies within the industry analysis, and then do what we call a fundamental analysis, which is, we have 15 solar companies. Let's look at each specific company and the history of their stock behavior and see, of the 15, what 3 companies out of 15 would be the best to short. Or if it's the airline industry, if they're poised to do better with lower jet fuel prices, what 3 airlines out of the 10 airline stocks would be best to own? JetBlue, Southwest, United, Delta. I don't know. I like Southwest though, because they don't charge for your carry-on or the bag you stow, and you can change your flight dates without any punishments. Like if you want to change your flight to a different day. And I hate Spirit Airline. The Spirit Airline, like, wow, what a great price for that flight. Oh, what? I have to pay $50 to check my one bag, and I have to pay $25 for a carry-on, and everything is, I need, things that you normally think would be free, like a bag of peanuts or a small bag of pretzels, you got to pay for. And then by the time you're done, you paid more than you thought that you saved. They tricked you with all these additional, so I'm not happy about that airline. Anybody fly Spirit? They have nice planes, though. The planes are pretty new. Not that I've heard of, but I'm not saying it's. What's that? It could be. I don't know. I know it's its own. It's just a spirit, and it's been. It could be. Sometimes the airlines do that. They make a sub carrier with a different name to target a different audience. You know. Okay, so let's talk about the efficient market. Efficient market hypothesis is that markets have a certain amount of efficiency built into them. And what does that mean? Well, I like to consider myself a very efficient person, and I like to, whatever I do, I want to do it in an efficient way. I don't want to waste time, or sometimes it kills me to hang out with someone who's inefficient. And I'm like, okay, we have these tasks to accomplish. If we take this route, we could hit all the stores on the right side of the road, so it's easy to turn into it and then turn out of the store. We don't have to cross the street. And like, I think about all these different parameters that would make driving to all the 5 different destinations the easiest, the most logical. And, rather than inefficient people would want to go here, then back over here, then maybe over here, then back up here, then home for lunch, and then back over there. Very inefficient. Just like, maybe when you do your course schedules, when you plan your course schedules, it's important for you to make an efficient course schedule. So all your classes are Monday, Wednesday, or Tuesday, Thursday. Or your classes are, maybe they're Monday through Thursday, but they're back to back in the morning or at night. Some of the schedule that would be efficient rather than having classes in, 5 days a week, 1 in the morning and 1 at night. Or 1 in the middle of the day, and you're stuck here for 5 hours between classes, which isn't enough time to go home, or, maybe you live in the dorms, I don't know. But you see what I'm saying? The market works that way too. The market has an efficiency about it. There are some people that are in the market that create inefficiencies, though. They're like these people that slow you down. There's two different types of people that go to the mall. There's women and men. Men just want to go in, get their underwear, and go home. And women like to walk around a little bit and shop. Is that a sexist thing to say? That's old school thinking, though. Maybe there are some guys here more metro, like Timothy, and you like to kind of take your time. Maybe, But the market could be that way, too. There could be people who, they buy their stock and they hold it, and that's it. They're very, and there could be people who are changing their mind quite a bit and buying stocks that are in favor or hot that day, then selling them and buying something else. So all this different type of trading activity by different types of purchasers, although it is true that they've done studies that in general terms, not in individual terms, men and women have slightly different shopping approaches. Although over the last 50 years, the difference is becoming smaller than they were, say, 50 years ago. But it's the same thing in the stock market. The differences are also narrowing between the way different types of people trade. The idea is that the market, though, for the most part, is efficient. We have all these buyers and sellers, all this volume, and when news comes in or things about a company change, the stock prices change in a very efficient manner. So which would say that everything is correctly priced at all times. The stock price you look at and you see today is the correct price at all times. And they believe that rarely is a stock mispriced. And it's very hard for anybody to find a missed or under overpriced stock because they believe the market is so efficient. So if the market's so efficient, why do we need securities analysis or any of this type of analysis? Most people believe that because you're doing all this fundamental analysis, that's why the market's efficient. Because there's so many people who are knowledgeable and understand and look at cash flows and financial statements, financial ratios, management of the company and prospects of their products, that all this research everyone's doing that enables them to buy and sell a stock is what created the efficient market. So if everybody just stopped doing the market analysis, the market would become very unbalanced, inefficient. So it's the work that everybody does. It's sort of like, millions and millions of people doing all this research and work and buying and selling stock to make the market efficient. However, sometimes people misinterpret things, and they go and talk about it, and they get other people to misinterpret it, and some stocks can go in one direction completely in the wrong way, because this notion has gotten out there about a company that just isn't true or just isn't reflective of reality. So sometimes there could be a mass confusion about the value of the prospects of certain stocks, leading to pricing errors. All right. So let's step back to the economic analysis. So if we look at the idea is the general economy, the position and direction of the economic activity will move stock prices. And the stock prices are heavily influenced by the changes of economic activity. And understanding not just the broad sense of GDP, but the more micro and micro and macro movers of the economy that could be specifically tied or connected to certain stocks that are could be more heavily connected to changes in interest rates, change in unemployment, change in just people's overall moods. The economy in the United States is doing well, but most people are still pessimistic about it. So that does have an effect on people wanting to buy cars and boats and luxury items and houses. When people are more optimistic about the economy and their job and things moving forward, people buy more. I think one of the problems right now in the economy is that people are feeling like, okay, I have a job and the economy is doing okay, but I'm not as secure in my job or secure that if I have to leave this job, I can get another one that's as good. Because it pretty much seems like think of a parking lot, in that imagine a parking lot that's full. And it's a type of parking lot where all the good spots are in the front and all the bad spots are in the back. But it used to be if someone left one of the good spots in the front, someone else would drive up and take that spot. Now, with our economy, if you think of the parking spots as jobs. If a good job is vacated by someone's death or retirement or changing to a different job, that parking spot is retired. They'll put cones in it so no one can park here. But they'll offer you a new parking spot in the back for less money, or a new job at the end of the line. So the good jobs, as they attrition or retirement, or just people leaving their jobs for any reason, they don't replace that position with someone at the equal level making the same amount of money. They want to go much, much cheaper. So a lot of the good jobs are disappearing in the economy and being replaced with lesser jobs, even though you may be doing the same work or similar type of work. You're just not being fairly compensated for it. So a lot of people are pessimistic about their future potential to move up. A lot of companies have been very slow to give wage increases or promotions. And this is making people feel equally sort of pessimistic that they're not really getting ahead anymore because they're not getting the promotions and increases that would make them feel more secure. And they don't have a real good sense that I could leave this job and get another one easily making more money. But as the unemployment rate goes lower, and the jobs have to compete a little bit more for workers, this reality should change. And that should really help propel the economy forward. But when that's going to happen, we're not sure. Now, we all know gross domestic product. It's a very broad measure of the goods and services produced by our economy. And what was our GDP this last quarter that was just announced? This is a piece of information all business students should know. It's the broadest, most talked about economic indicator. If you have one of those laptops I see, maybe you get off Facebook for a second and look up GDP last quarter. It was pretty amazing GDP. No, we're talking about percentages of increase, like 4% or so, and change. 4.2? Yeah. That's a huge GDP increase. We've been running around 2%. That's probably looked at the older quarter. It's been 2% or around that for a while. This is our first real strong GDP. Um, but that's measuring what happened last quarter. It's not what's happening right now. So it's a lagging indicator. Industrial production is more of a forward indicator, looking at, what is industry doing? Are they ramping up to make more products? Are they increasing their activity? Because that usually means that demand is increasing, which is a good sign the economy is going up. We also want to keep, when we're doing our economic analysis, we want to think about taxes, government spending, and debt management. Right now, with the gridlock in Washington, there really isn't that many changes in tax law or government spending or any debt management. The government just could have been at the standstill for the last 5 years or so, not wanting to do things, but not being able to get both parties to agree. So not much is being getting done. Monetary policy, we're coming up to a huge shift in monetary policy where money supply is being affected as the Fed stops buying its quantitative easing programs and stops buying bonds. And the interest rates are being said by the Fed. Last week we had the market went down tremendously on negativity, and then the Fed minutes said that, hey, we're pretty confident we don't need to raise interest rates into 2015. The market went up 270 points, and then the next day people got negative again and went down 200. So we have this volatility based on, daily information. And we had one day of good information, which is basically the Fed is not poised to be very aggressive to raise interest rates for the rest of 2014, and they're going to be very cautious in 2015. Other factors, inflation. When oil prices are one of the main ingredients to inflation, and with oil prices heading lower, that should ease off inflation. And oil is a significant component to all the food we eat. The growth of the food, the fertilizers, the transportation of these foods, the refrigeration of the foods. A lot of them are tied to fossil fuels. So lower cost of these helps to hold down inflation. Which, if inflation isn't stable, that's a very good thing for stocks and business. The consumer spending, we look at Christmas season's coming up, and we want to see how much people are going to spend. So if consumers are spending, that's a good thing for the economy. And consumers spend. Every year we can look forward to consumers spending more. Business investments, how much, and this is one thing where things are trailing as far as businesses investing in new machinery, equipment, buying new businesses, expanding operations. We're seeing that these businesses have huge balance sheets of billions of dollars, but they're being very tight-fisted about spending it on investments. And that's usually one of the reasons this last recovery has been so slow to gain traction and really accelerate quickly, is because businesses have been, very willing to pocket their profits but not spend it, either on salaries or on expansion, which means that most business leaders are a little bit nervous. They want to have this money as a backup, or they're just not, they don't see the opportunities to spend it. Foreign trade and currency exchange rates. Both foreign trade and currency exchange rates have been greatly affected by the oil boom in the United States. Us becoming energy efficient, producing all the oil that we consume, has helped strengthen the dollar, as we have to borrow less dollars to buy foreign oil, and has helped balance our trade, because a big imbalance of our trade deficit came from purchasing oil outside this country. As we're buying more of our own oil, that trade imbalance becomes more balanced. So it means that, less dollars being, having to be spent for foreign trade. Okay. So other key indicators, leading index of leading indicators, it puts together a bunch of leading indicators to help us predict where GDP is going to be next quarter. So it's more of a forward predictor, a better predictor for stocks. So look at this index of leading indicators, which is a sort of a group of indicators. Personal income. This is where we've been lagging in our economy. Personal income has not really grown much. And even though employment has come back, we've lost a lot of those good parking spots and added a lot of the bad parking spots. Sort of like what they do on campus. We're always doing construction work somewhere, ripping up the good parking spots and closing them down. And then, well, you guys don't park in the regular lots on campus too often, but they're always doing some kind of construction, ripping things up. You have to park out in exile land and take the bus to campus, which for a lot of students is a deal breaker to even coming to the school, right? But personal income has been flat. Companies are not giving raises or giving very small raises, and raises equal to or less than inflation. So, and the new people getting jobs are not making as much as the old people who lost their jobs or left the job market for retirement or whatever reasons. So that's making people, you're gonna feel this somewhat when you graduate and you want to get your first job, and companies are being a little picky, a little stingy with what they're going to offer you. You know, because the demand right now, it's all supply and demand. If there's more of you looking for, if they get 1,000 applicants for an entry-level position, they don't feel that they have to pay you $48,000 a year for that. You could probably, hell, you'll probably accept 35, so why not pay you 35? That stinks, right? But that will change. It always changes. But right now, that's how it is with consumer. You know, personal income is not growing as fast as we'd like it. Retail sales, again, you know, we talked about this earlier. We want to see retailers selling more. The money supply, you want to grow the money supply to encourage the growth of the economy. Because the economy needs a certain, think of the economy like an engine. And the bigger the engine, the more oil it needs. And the money supply is like the oil. So if you want to have a bigger economy, you have to have more money out there. That's one of the reasons that we don't use gold as money, because it's so finite, there's so little of it, that we wouldn't really be able to build a big economy off of it. So we have this paper money that we could use to pump into the economy when we want to give it excess grease to, you know, move faster, to rev up faster. And right now, the Fed is trying to limit, slow or reverse the growth of money because there's too much out there. So that could reduce economic activity. Consumer prices, producer prices. This is basically an indicator of inflation. So this is looked at the CPI is looked at very closely to see, are prices going up? Is inflation sparking? And if so, it's dangerous for stocks, because that means that if it costs them more, basically translates into them having to pay more to make the same products to you, which means they have to probably raise prices at some point. And if you have a fixed income, that doesn't mean you can't buy more, you'll be buying less. You know, I remember in the 2008 economic Great Recession that a lot of restaurants were suffering because the easiest way to save money for a lot of people is to stop going out to eat. So I was at the Cheesecake Factory, and instead of leaving a monetary tip, I gave the waiter a tip saying that you should buy Cheesecake Factory stock because it's only $5 a share, and in a couple of years you'll be back up to 25, and that's your tip. And you know, I'm usually a pretty generous tipper. You know, I like to tip at least 40% of the time. So, but these are things that, you know, that's a very sensitive industry. And that sort of, the cost of eating out has helped develop a whole new segment, which we talked about last time, that fast casual segment. Panera and Chipotle being the two biggest. Even Chicago Uno is trying to get away from restaurants and more into what they call Uno Fresco, or a new type of style restaurant where it's that fast casual, because the people preferring that dining style. Unemployment. Unemployment rate has gone down very low, but reasons why the Fed isn't too concerned about it is because the participation rate, the amount of people, the percentage of Americans who are working, I think it went from like 66% to 62 or 63%. There's less of us in the workforce that just gave up, and there's still a huge amount of underemployment. So even though the unemployment rate is low, a lot of people have taken jobs that are underemploying them, that, you know, isn't going to spark inflation or wage inflation. So people are just taking, a lot of these new jobs being created are in the service low paid area. So even though we've taken down unemployment, a lot of the reason is because unemployment insurance has run out for a lot of Americans and that were unemployed, and said, okay, I'm not getting any unemployment insurance, so really time's up. I got to take whatever job I can get, and they've been taking these lower paying jobs just so they can survive. So it looks good for the unemployment rate, but isn't really overall inflationary pressure or really great for the economy. So that's why the Fed's not so worried about that, and is giving it a little bit more time so we can get a little bit more competition in the employment area, so wages go up. Okay, and then housing starts is another key economic indicator. If people buy houses, that's great for the economy because then they need to buy rugs and furniture and flooring and window treatments and furniture and dishes and, you know, right now the housing has been doing good for a while. Right now it looks like it's stalled a little bit, so that's putting pressure on home building and housing supply stocks. One key stock I used to follow is called Lumber Liquidators, symbol LL, and when they just make they sell flooring products, and when the housing market started to turn around, they were selling a lot more of these flooring products because generally flooring looks terrible in most houses. If you want to sell a house, you put new flooring in, it sells pretty well. Or if you buy a new house and the flooring is terrible, you may want to change that so their products sell. But they've gone down tremendously lately because the housing market's suddenly kind of stalled. All right. This is one of the charts from the book, and it talks about the direction of and the effect of different economic variables on the economy. I really kind of talked through most of this. One thing here that wasn't said on the other pages was the corporate profits. So corporate profits, they are up and they've been doing well. So strong earnings are good for the market. And that's one of the reasons the stock market has done so well in the last 5 years is that corporate profits haven't disappointed. They've come back and they've done very well. And that translates directly into growth in earnings, growth in revenues, growth in earnings per share. All these things propel stock prices higher. Now, companies are being criticized for not taking these profits and giving their employees higher wages, or taking these profits and spending money investing on new capital goods, machinery and equipment to improve their businesses. So that's why that hasn't translated into a much stronger economy. And of course, trying to develop your own economic forecast is very difficult. In fact, most economists often are wrong when they predict where the economic activity are going to be for next year. But generally, many publications will talk about or discuss economic activity on a daily basis. Even Yahoo Finance, and they always have a lot of economic trends, and they'll talk about it. So it's a very difficult thing on a day-to-day basis to predict where the economy is going, but you sort of build up a collection of pieces of information to help get you to an understanding of, should I be worried about this economy, or should I not be worried, or should I be hopeful about this economy? And we use this economic inventory, economic analysis to give us an idea of what industries are going to be benefit from this and what industries will be hurt. And I gave you examples of the oil before. And we can use that to evaluate individual companies, whether or not their sales will go up or down. So if the economy is expanding and consumers become more optimistic, then certain bigger ticket items like cars, houses, luxury goods, they typically tend to do better, and those companies move higher. If people are feeling more pessimistic, they may stick to companies that have more reasonable products. Now, a really important thing to remember is that stock prices change well ahead of the economy. In 19 of the past 20 recessions, stock prices went down first, then there was a recession. So stock prices are often a predictor of recession. So if we see the market go down 20, 25%, and we're like, why is this happening? The economy seems fine. 6 months later, the economy is terrible. Because the idea is that people in the financial markets who buy and sell stock, they're a little bit more attuned to where the economy is going than the average investor. So they're able to pull their money out of the stock market faster when they see the economy tanking, which we'll recognize a lot earlier. And the same is true. The stock prices move up quickly like they did in 2009 before the economy moves up. The stock prices will move up fast before everybody recognizes or generally accepts that the recession, before people say the recession is over, stocks will move up quickly because they know the recession is ending and they want to get in at the lower prices. So the stocks themselves are a leading indicator. So if we have a 20% correction, that could lead to a small recession. Okay, talking about the industry analysis a little bit more in depth. We're looking for which industries will have a strong competitive position based on the economy. And we're looking for not just new opportunities, but potential growth in existing industries as well. Once we pick an industry, maybe we'll pick semiconductors. That's an industry that makes all the components for electronics. And maybe we'll say it's promising because people are buying more and more electronic items, and the world's getting more and more computerized. So we can identify companies within the industry that look the most promising. So if you're a semiconductor that provides Apple with a lot of components for their phones and computers, you probably have a very promising sales and revenue. If you're a company that supplies a lot of components to Microsoft's Surface tablet, probably not going to do as well. Sorry to the one person who has a Surface tablet in class. Are you here? I don't know, maybe it was another class. They all blend together. So we want to find so the semiconductor could have 40 companies in the industry. What are the top 5 companies that have the strongest pricing position, the best products, the most potential for growth? Because those are the ones you want to own. So the idea is I can point to 7 industries that are going to do well in this current economic situation, and of those 7 industries, there's 500 companies within those 7 industries, but these 20 companies I feel are the strongest positioned within all those industries, and that's how you build a winning portfolio. Now, when you look at an industry, though, you want to really understand what is the nature of the industry. What's the nature of the airline industry? Well, they fly people from here to there. Okay, well, what affects their profitability? Well, oil prices and price competition. So if airlines are lowering prices to attract business and they keep cutting their prices to become a discount carrier, that's going to affect profits. If oil prices go up tremendously, that's going to affect profits. And that's one of the things about bags, that if you make bags free on your airline, one day they realize, you know what, we should limit the amount of pounds that these bags can be, and then charge if they're over 50 pounds. Because every pound you put in a plane is more fuel it consumes. So if you could have a plane, there was actually one airline industry I read, I forgot which one this was, encourages its passengers to use the bathroom before boarding the plane to lower the weight of the plane. So whatever weight you can reduce on the plane is more profits for the airline company. So if they charge you for a second bag or charge you for an overweight bag that discourage you from bringing more and more heavier bags with you on the plane, they'll make more profits. So these are the different nature of the industry. So if you have an airline industry that's not in a price competitive position on lowering prices and the oil prices are going down, the profits should go up. Especially after all the cost cutting and efficiencies they put in place, buying more fuel efficient planes and reducing the amount of in-flight freebies and food and charging things for in-flight drinks, raising prices. All these things they did when times were tough are now going to make these companies even more profitable when times are a little bit easier. As far as is the industry regulated, airline industry is regulated, oil industry is regulated, financial industry is regulated. How do these regulations affect profits? Defense companies are regulated in a certain respect. What type of role does labor play in the industry? Is it the type of industry where you can easily just hire people for minimum wage? Or is it an industry where you need a lot of engineers and highly technical people to sell the product and you have to pay a lot more? And how important are the technological developments in the industry? Is it really, if you're talking about cell phone industry, the tech developments of making the cell phones and features and smaller and transistors and more battery power are tremendous. If it wasn't for the cell phone industry, the advancement of batteries would never have come as far as they are today. Because the cell phone companies invested so much money to get smaller and more efficient and longer lasting batteries. That's what is really making it possible to have marketable electric cars today, because of all the money spent in these battery areas. How does economic forces impact the industry, and how important are the financial and operating considerations in a certain industry. So some industries are relatively capital light, like say an industry that puts up websites or sells domain names, or like GoDaddy.com, and they don't need a lot of infrastructure. But what if you're going to be open up a new franchise of coffee and donut shops? You're going to need a lot of money to buy all the equipment and get all the retail locations, and very capital intensive. So industries that are more capital intensive are a little bit slower and struggle a little bit more to grow and to make profits because they have to spend so much money. That's why companies like Amazon can do better than retailers, because they don't have as much capital tied up in brick and mortar, as they call it. Now, the economy goes through growth cycles and stages. And a lot of that's tied to specific companies and industries. As the industries and companies grow, that helps to grow the economy. Now, if an industry is new, generally the risks are very high. So if an industry that's kind of new and being developed, sort of like when the internet industry was being developed in the late 90s, there was a lot of risk in many of those companies. And many of those companies went bankrupt. But then at a certain point, you go through what would be rapid expansion, where companies start getting it right and start developing these mega companies like eBay and Amazon and Google and Yahoo, and all these companies start to really get it right, and they start to grow rapidly. Then you get to a certain point where they're at a mature phase, where they really kind of got as big as they can perceivably get. There's no real high growth areas, and then at some point they stabilize or decline as new competitors come in, as they build their winning models, and competitors can copy and move in, and it's going to reduce or decline the industry. If you think of an industry like, say, the DVD player, there's an industry that when that initialized, it was slow to take off because the DVD players were so expensive. But then there's a rapid expansion. Same thing with HD TVs. And all of a sudden everybody has an HD TV or a DVD player, and then like the TVs have matured, the DVD players are declining because now people are using digital downloads and instant viewing for a lot of their movies. They don't need DVDs, the physical component, or streaming of sources of industry outlook. These are just publications we talked about before that can give us information about industries in the outlook. Also, Hoovers.com is a good site as well. Okay, so the final step, which is really the heart and soul of this chapter, is the fundamental analysis, where we're going to evaluate the financial conditions and operating results of a specific company. So the idea is we have an industry of 10 companies. We want to fundamentally analyze each of those 10 companies to figure out which are the two best to buy, and maybe we'll find one that's a good one to short. So we want to we want to evaluate their competitive position. Are they the number one company in this industry, or they're somewhere in the middle? What is fueling their growth in sales? If you look at Apple, it's no longer the iPod fueling growth in sales, it's the iPhone and the iPad. But they transitioned away from the iPod. I don't even think they may not even sell the classic iPod anymore. Yeah, because it's really not. But the key thing is that as those sales went away, they had other products to pick up the slack. The profit margins of the company, are they stabilizing, growing? Profit margins, when you played that Zoom simulation in the finance class, in order to do well in that game, you had to constantly increase profit margins. If you weren't doing that, you were falling behind. That's the same reality in the world today. Every company has to maintain or improve their profit margins every quarter. It's a constant struggle and battle for every company to manage their profits and increase their profits. And they've gone to extreme lengths and extreme innovation and technology over the last 50 years to keep doing this. If you looked at the evolution of a car over the last 50 years, a lot of the changes in the car have been made to increase profits. Swapping out expensive materials for less expensive materials, redesigning cars to use less components. Everything's been done to still give you a good car, but that costs them less, though. because they want to increase their profit margins. Unfortunately for the labor market, companies have been pretty good at keeping wages down, lowering bonuses and wage increases, and hiring at lower levels of income, or designing their companies where they don't need as many people to work in the company through efficiencies of robotics and computerization, better training of current employees. So one employee can do the job of two former employees if they're better trained and you have more technological assistance. I remember when I first started in accounting, the company never changed in sales or real scope of what they manufactured, but we started out, there was 36 accountants in the accounting department. By the time I left, that was down to 12. And a lot of those other accountants were always laid off. And I always dream of being laid off when I was an accountant, because I hated being an accountant. And I was like, oh, if I could get laid off, that'd be so wonderful. I wouldn't have to feel guilty about leaving account, just quitting my job, and I'd have a good excuse. Well, I got laid off. What could I do? Get unemployment. But so when I finally did leave, I went to my boss and said, why didn't you, you shrunk the department from 36 to 12 people. I know I'm not the best accountant. There were a lot of other people you laid off that were much better than me. Why did you keep me? Oh, well, you never really made that much money, so we never even considered you. So I'm like, okay, well, that makes sense. But by the way, that's why I'm leaving to another job to make more money, because you don't pay me enough. They're like, that's fine. You weren't that good of an accountant anyway, so see ya. Okay. So the value of the stock is definitely influenced by the financial performance of the company, and investors expect continuously growth in sales and profits of the companies they invest in. You don't want to invest in a company that's standing still or moving backwards, because the stock price will stand still and move backwards. So you want a company increasing revenues, increasing profits. And that's why basically what we're doing when we look at the fundamental analysis of a company, we want to see when they do make profits also, what do they do with those profits? And that's primarily the strength of the balance sheet. Are they, investing in the company? Are they, how are they spending this money in their asset mix? And how are they funding these assets? And that would be more of the financing mix. Are they growing this company through taking on too much debt, which would be a risk? So where do we start? We like to start with interpreting the financial statements. And in order to do that, if you're not a trained, highly effective accountant, it's very difficult to analyze financial statements. But that's why they came up with financial ratios, which are a shortcut to understanding and analyzing financial statements. They can get the job done much more efficiently. And it's a very demanding and time-consuming task to do a fundamental analysis, looking through the financial statements and interpreting the financial ratios of a company, but it's really one of the activities that gets you to know the company the best and gives you a better chances of actually buying a successful company. Okay, so I'm going to start here next week. Wednesday. We'll review the financial statements quickly and then get into the financial ratios.